Hello, class. This is Mr. Parker speaking. We are going to discuss the three types of investments. Now, there's a way that if you have extra money, instead of just saving the money, you can make some more money on top of that. Okay. A good thing to do is to save money away for later is called investing. Okay. Investing is money you make on top of the money, all right, that you have earned. Okay. What are the three ways you can mainly invest? Well, the first thing you can do is stocks. And stocks usually are going to yield the most benefit of any of the types of investments, but they are also the most risky. So we'll talk about risk and reward in the next slide. Typically, a stock, if you keep it in as a long-term investment, you gain 7 to 9% on your money over the period of time where you invested in, and that's significant. Bonds are another thing; they're a little bit safer, and we'll discuss that in a little bit. And that typically makes it 5 to 6%, versus if it's a savings bond or a corporate bond. The third type is to invest in cash investments, and those are called CDs, certificate of deposit, or money markets. And those are safest, lower risk, and lowest reward, about 1 to 4%. So that's something you need to think about is what kind of money you're willing to risk. So you see this picture, and this picture is kind of significant because it shows that, and we'll go a little bit into the next slide, is people are rolling the dice, how much money you make. It's still a risk in with your stocks or your bonds, that they can gain or lose money. So let's talk about risk versus reward in the next slide. Okay. Another thing I mentioned is commodities. Commodities could be anything from cash, that gold, if you buy a luxury car, oil, you can invest in those things. And if they raise in value, basically the value of those commodities, if they increase, you sell them, you buy them, and you wait for them to what's called mature in value, and then you sell them later. Okay. Usually that's not a very good form of investment, honestly, to do unless you're given this type of investment. It, it's handed to you. It's good to keep on to it, but not very good to invest in cash and invest in currency. Okay. So let's talk about investment, risk versus rewards. Okay, so they're two different things. That first, risk is the chance of losing the money. So you see this guy right here. Um, he's playing a Jenga piece. All right. Any investment that you make over a certain amount of time, you run the risk of losing your money. Okay. However, it is very important to know that all of this stuff is long-term investments. Okay. If you keep your money in for a long period of time, whether it's stocks or bonds, on average, you're gonna make a good amount of money. Okay, you just need to be patient with investing your money. Okay, the reward is there's an amount gained on top of the money that you invested. So there is this money right here you see, as a reward you get just for putting your money in these investments. So your money is making money for you. Now, typically, it goes high risk, high reward. So things like stocks, where you can lose your money, but they're going to give you a higher, if you keep your money in long enough, they're going to give you a higher reward. It's not smart to do anything that is so high risk. All right, be very skeptical of things that are promising you very high interest rates and very high returns, because there's a very high risk of you losing all of that money. Now, there is a chance that you could get a high reward, but um, typically it's very risky. You want to have your money be safe. And if something's a low risk, typically it means that there's a low reward that goes with that. So that's your certificate deposit, savings account, or savings bonds. All those stuff are very low risk because they'll be there, but you're not going to gain a lot of money on top of it. It's important to know that all of these investments are long term, meaning that if you keep your money in it over a long period of time, it will make a significant more amount of money for you. Okay. Also, make sure that you don't need that money in the future. So it's not a wise decision for you to put all of your money in investments and then have to pull them out because then there's fees and your rates are not going to mature. So let's look at some of the stock terminology involving around stocks. For instance, stocks are a high risk and high reward investment. As you can see, this is a graph. Notice that the stock market goes up and down over time. It's not a promised rate. So that's why it has a significant amount of a high risk to it. All right. However, if you keep it in over a large period of time, there is a high reward that goes along with it. Okay. How do you make money? Well, there's two ways. One way is you wait for the stock to rise in value once you buy it, and then you sell it at when it's worth more. Or sometimes a company will pay you what's called dividends. If they make a profit, they'll share some of that profit with you. Okay, and they'll usually form that in a form of a check or direct deposit. What are some other terminology involving stocks? Well, these are the three stock indices which you can look at: the Dow Jones, the Nasdaq, and the S&P 500. So just when you hear those words, those are just the different stock markets. And basically, stocks are investing in companies. So you can see like Walmart, Disney, all of those are corporations. Okay, you can invest in a single corporation, or you can invest in a series of ones called a mutual fund. Okay. For example, this is Amazon, and this was a wise investment to make 20 years ago. If you invested in Amazon, for every dollar you spent, you would get about $500. Okay, now you can't often predict exactly the way that stocks are going to go, but again, over a period of time, stocks tend to increase the most in value. So here's some other terminology, is that you'll hear when the market is good. So there's sometimes they're called a bull market when the stocks are rising in value, in a bear market. Now it's important to know that to not be scared about these terminologies. For instance, currently we're in a bear market, and typically if you diversify your investments and keep the money in the stock market a long time, it will turn around to becoming a bull market and you'll make money. So it's important not to be scared by these terms. Okay. Bull market means it's good. The stocks, typically all the stocks rise in value. In the bear, they're losing. And that could be for a variety of reasons. Maybe the company is doing well. But we'll talk about ways to diversify your investments so you're not basically spending it all in one company or one stock, for example, Amazon, or like we showed in the previous slide. What is another way you can save? One is bonds. And bonds typically have a moderate risk and a moderate reward. Now, the problem with savings bonds is that you have to keep them for 20 years in order for them to say that, which they call they are mature. If you cash them early, then you're not going to gain all of that interest. Okay, so the savings bonds are typically the government is issued by the government, and you get the interest after a certain amount of years. A corporate bond works the same way. The company promises to pay you back over a certain time with interest. And that's going to be a little bit of a lower risk, but a lower reward because Typically, strong companies, IBM, Walmart, Disney, have been around for the past 100 years or so. So they typically tend to be able to pay you back over that certain amount of time. What about cash? And these are very low risk and very low reward forms of investments. Okay. So first off, we have currency and commodities. Okay, so that could be anything like gold or sometimes in different currencies of countries. And they work very simply that you buy them when they're cheaper, and then over time they rise in value, and then you sell them. Okay, now this isn't a very good idea because it doesn't earn you a lot of money, and there's a lot of fees to try to invest in these types of currencies. We hear of cryptocurrencies, they're very unsafe, and they can change very quickly. Okay, one way is to invest your money is a CD or money market in a bank. Okay, that is a promised amount of you leave your money in the account for amount of time, and they'll pay you a higher interest rate. Okay, but then again, all of these things I'm need to stress are long-term investments. You can't just buy and sell them and expect to make money very quickly. So, what are some ways you can make your money a little bit safer? Well, one way is to do something called mutual funds. And that's when you pay somebody to make a combination of stocks and bonds together. So you have something called Invest puts together a fund manager. They invest in a variety of different stocks, and you save the returns. And I do have many mutual funds. And for instance, I invested in something called a mutual stock market fund where I invest in all of the stocks as an average, and then I get a certain percent because usually the stock market gains in value over time. Now, it is important to note um, that if I invested in one company, let's say it's Disney and they lose a lot of money, then I am going to lose all that money. So it's not a very safe investment. Mutual funds are much safer. Okay. What are they? The advantages are it's diversified, meaning there's different, you're not putting all your chances in one stock. There's experts that manage the money usually, and it's simple. So, what are some ways you can save using these stocks? Okay, well, one is an IRA. Okay, and that you can contribute up to 6,000 a year, and it's important to know that in an IRA, if you start early, all right, it's tax free, and it just shows you as a 20-year-old how much more money you can make. You can almost make 20 times more than if you started as a 40-year-old. Okay, so from investing from 45 years to 25 years. So look at all of this growth you can make if you do it early. So invest early as much as you can. Okay, contribute as much as you can to this. Okay, and an IRA is basically you put your money in an account. Could be through stocks or whatever you choose, and it's tax free. So, last thing, when you are searching for a job, it's important to think about things that could be available, like 401ks, okay, that the employer sponsors, or your boss or whatever you have. It's pre-tax deductible. Um, it's also good because there are many things that you can do. The company sometimes matches, meaning they will put as much money as you put up. So it's basically double the money you put in. Um, it's tax free, and you can have it so it automatically takes out of your check, and it automatically deposits into a certain account. So that's very important. All right, these are all investments. Remember, they are all long term, and you should try to start them as early in your life as possible. Okay. If you have any questions, please let me know. Fill out these notes, and please consider investing as early in your as possible. And remember, these are all long term. It takes a while for these investments to make money.